Are you worried about not having enough money to retire? You're not alone. A CIBC survey showed that 79% of Canadians aged 35 to 54 are concerned about not having enough money to retire. And in this video, I'll go over all the ways you can figure out how much money you need to retire in Canada. Hey, what's going on? It's Chris here from Wealth Awesome. My parents have both recently retired, so I saw firsthand at how complex it could get when trying to figure out how much money you actually need in your retirement years. There are so many factors to take into account, like government pensions, savings and investments, plus quality of life that you want to have. I always like to look at the data of what other people are doing before making any choices. So let's start by looking at what the average spending of Canadian retirees are. The 2017 Survey of Household Spending by Stats Canada found that the average spending per household for Canadians over the age of 65 was $60,359 per year, and that's including tax payments. If you assume that you and your partner will retire at age 65 and you'll need the money until age 82, this will be equal to $1.03 million spent during retirement. Keep in mind though that these are average numbers and yours could be much higher or much lower. And I'll go into this in way more detail as this video goes along. If you're looking at that number and thinking that it's way too high though, continue watching this to see how you could save and invest to reach your goal. Stick around till after this video is done and I'll go over my personal thoughts on how much you need to retire. If you get lost during this video and want to check out more, look at wealthawesome.com. I made a written article about this video that goes in a bit more detail. Okay, let's go with some simple retirement saving rules to kind of follow. Rules are a way to simplify a complex concept and might not suit your exact situation, but I feel that they're always a good place to start if you're not sure of how much you want to save or invest. The first part I'll go over is some simple rules, and the second part of the video will go over how to budget in detail. So the first rule is the 50-30-20 rule. A popular rule of thumb is to use 50% of your money on needs like housing and food, 30% on wants such as travel or entertainment, and 20% on savings. So is 20% savings a reasonable amount? I wasn't exactly sure, so I did some calculations. I assumed that if you invest all your money at a very conservative 4% investment rate of return, a savings period of 40 years between the age of 25 to 65. I also assume that people would take advantage of their TFSA and RSP accounts. So to simplify, I decided to use zero taxes in this. And here are the results below. So as you can see, if you average a $50,000 salary per year and you save about 20% of it per year for 40 years, at an average rate of return of 4%, this equals almost $1 million. You get $950,000 at the end of it. And if you have double that amount, it'll be $1.9 million. So as you can see, even with only a $50,000 average salary throughout your entire career, if you save 20% of that and invest all of your money, you'll have almost $1 million by the time you retire. The 20% rule then seems like it should be adequate enough for most people. The second rule I'd like to point out is the savings by your age rule. Fidelity had come out with an interesting rule of thumb which states that you should have a multiple of your salary saved by the time you hit a certain age. So for example, if you're age 30, you should have about 1 times your annual salary, meaning if you make $100,000, you should have about $100,000 saved. Age 40, it's 3 times. Age 50, it's 6 times. Age 60, it's 8 times. And by the time you're 67, you should have 10 times your annual salary saved. So if you have a $100,000 salary, you should have $1 million saved. And they've stated it's likely you can achieve this goal if you start saving only 15% of your income at age 25 and invest at least half of your money into stocks over your entire lifetime. So that's a very reasonable goal that most people should be able to hit. Third rule is the years multiplied by the expenses rule. So this is how you figure out how many years you will live and multiply it by your annual expenses to get the amount that you will need to retire. The older you are when you retire, the fewer years you will have for retirement. So for example, if you retire late at say age 70 and you calculate you'll need $80,000 a year when you retire and want to have that money to last you until age 85, which is 15 years, 15 times $80,000 is $1.2 million, which is the amount you should aim for having when you retire. The fourth rule is the 4% rule. And this is where you figure out how much you need in annual income to live, then multiply that amount by 25, and that is how much you will need to retire no matter how old you are. In theory, even if you're only 30 years old, you can retire and have enough money to last you for the rest of your life. If you're only drawing out 4% of your portfolio, it should sustain you throughout your whole entire life. And this 4% rule has been popularized by the financial independent, retire early, or the FIRE movement, but it can be used by people at any age, not just young retirees. So for an example, if you want to retire at age 40, you figured you'd only need $40,000 per year when you retire. If you multiply that by 25, you'll need $1 million to retire. That is a very simple rule of thumb and gaining popularity in recent years. Again, I want to caution against just using these rules of thumb. I definitely think you should do more in-depth analysis when figuring out how much money you need to retire, but these are a great starting point to get kind of a ballpark estimation of where to start. So this next section is for those who want to dive deeper into how much to save for retirement and don't want to just rely on a simple savings rule. Step one is to figure out in depth how much money you will spend per year in retirement. And there are a few ways you can estimate how much money you'll spend when you retire. The first way is the 70% pre-retirement income rule. So this rule is that you'll need about 70% of your pre-retirement income to spend every year in retirement. So for example, if you make $100,000 before you retire, you'll need about $70,000 per year after retirement. The second way is a variable percentage of that pre-retirement income rule. Some people find this first 70% rule too rigid and doesn't apply well to all income levels. This variable rule states that the more pre-retirement income you make, the less percentage you'll likely need when you retire. Here's a chart that illustrates that point. Lower income earners, so those that earn less than $50,000 per year, will spend about 80% of their pre-retirement income per year. Middle income earners, so that's between the $50,000 to $100,000 per year, will spend about 65% of pre-retirement income per year. And higher income earners that earn over $100,000 will spend 50% of that in their retirement years on average. So this is kind of a nice way to try to customize it more towards your needs. The third one that I like is detailed budgeting. So the closer you are to retirement, the more detailed you can get with your budget. By this time, you'll have a clearer picture of what your life will look like after retirement. So some important things to consider are: what type of property do you want to live in? What kind of traveling do you want to do? Will there be high healthcare expenses in your retirement years? So if you're in Canada, maybe not so much. If you're in the US and you want to retire there, obviously going to be huge high healthcare expenses. And lastly, is your mortgage paid off, and do you have grandchildren or children to care for? So after you figured out how much money you'll be spending, step two is figuring out how many years you will be retired. And this is a tough part because you'll have to figure out how much money you need, and that's when you have to stop and think is how long you'll live. And it's not pleasant to think about death. But with retirement planning, it is very necessary. Let's try to take a cold look at this. So the average life expectancy in Canada is around 82 years. So unless you have some major health complications, you should plan to have your money last until at least 85 to be safe. I recommend planning for at least 90, which gives you a lot of buffer room. And the older you are, the less money you'll need to retire, as you'll have fewer years to live. A person retiring at age 60 should plan to have 30 years of retirement income versus a person retiring at age 70 who only needs to plan for 20 years. Step three is how much government income you will receive. The two primary sources of government retirement income are from the Canada Pension Plan, or the CPP, and Old Age Security, or the OAS. It's a bit tricky to estimate your exact CPP payments, but know that while the maximum you can receive is close to $1,200 per month, the average is closer to about $600 per month. Your OAS payments are easier to estimate. If your income is under $75,910 per year, you'll receive $613 per month. And if your income is too high, you'll get what's known as the OAS clawback, and your payment will be deducted. Step number four is to take stock of your current assets. And while this will vary significantly by individual, some of the major assets to consider is any equity in real estate that you might own, your TFSA and RSP, and any workplace pensions that you might have. The fifth and final step is to tie it all together and to calculate how much you will need to retire. So for a ballpark estimation, here's a simplified example which doesn't take into account any investment losses or gains, plus assumes a 0% rate of return in retirement, so it's likely an overestimation. But this will give you an idea of how to estimate your retirement number. So for example, let's take a look at Greg here. So Greg is 40 years old. He wants to retire when he's 60 and hope that he lives until 90. So he will need 30 years of income. He's calculated that he'll spend about $50,000 per year in retirement. With his CPP and OAS payments and his pension from work, he estimates he'll actually need only about $40,000 per year, or roughly $1.2 million throughout the 30 years. His current assets are worth $500,000, mainly in his primary residence, TFSA, RSP, and workplace pension. So that means he'll need to increase his assets by $700,000 to reach his goal by age 70. And he has set up a savings and investment plan that will help him reach that goal. Saving versus investing for retirement. I want to point out, if you're only saving your money in a bank account, it's going to be very difficult for you to hit your retirement goals. Most of the major banks have extremely low interest rates below 0.1% per year, which won't even come close to keeping pace with inflation. But with online high interest savings accounts like EQ Bank, you can get a much better rate, which currently it has a 1.25% interest rate. I put a link in the description below. Compare this to if you invest in the stock market. The US S&P 500 index has returned 12.1% on average for the 40 years ending on December 31st, 2019. And the TSX index has returned 8.8% on average over that same time period. For a long-term estimate of the TSX and S&P 500 going forward, I would conservatively forecast a 5 to 7% return, which should still be well above a simple savings account. Alright, so now that you've figured out a good savings and investment plan for your retirement income, here are some life changes that could throw it all off track. Retirement planning is all about making adjustments. Life is unpredictable, and chances are the retirement plan you make at age 30 will look nothing like your reality at age 50 or 60. And here are some factors that will make you need to revisit your retirement calculations. Number one is significant changes in your income, such as landing a much higher paying job or losing a job. Number two is large changes in your asset value. Real estate is a good example of this. Anyone who's owned a property in Toronto or Vancouver in the last decade has seen enormous gains in their asset value. But Albertans, for example, have not been quite as fortunate. Number three is investment gains and losses. Number four is health issues that can cause a change in your life expectancy. Number five is changes in family life, such as getting married, having children, or getting divorced. Retirement planning is tough. You're trying to forecast something that will happen like way out into the future. And there's adjustments and mistakes that will be made along the way. So don't be too hard on yourself and just try to adapt. By planning out how much you need to retire, you will increase your chances of hitting that goal. It's also a relief to have a retirement plan, and it will get rid of some uncertainty in your mind. I also think it's very important to have an insurance plan in place. So something like life insurance in case something terrible happens, or disability insurance or critical illness insurance is something that's a good idea to look into as well. So I mentioned earlier, EQ Bank is a great way for your savings. If you want to hit your retirement goals, look at Wealthsimple Trade for investing. They have free stock and ETF buys and sells for Canadian equities. I put a link in the description below. You get a $10 sign-up bonus. Since you made it this far, make sure you like and subscribe to the channel so you don't miss out on any future tips. Also, be sure to check out the blog, wealthawesome.com. It's one of Canada's leading personal finance blogs, and it goes into this topic in way more detail and has way more topics for you to look at. So be sure to check it out, and as always, thanks for listening.